Hey guys, hope you're having a great day. Your buddy Tim back with another video, and in this video we're going to look at investing in real estate. Specifically, is it better to be a flipper or to be someone who buys and holds property for the long term? Now let me say this right up front. I know a lot of you guys are not interested in investing in real estate. You watch these videos because you want to know more about North Alabama and what the housing market here is. But if you think about it, the investment property outlook here could also be important to you because you may end up buying an investment property that someone like me has flipped and put back on the market. But if you are not interested in learning about investing in real estate, I understand. You can go watch another video. A lot of cute cat videos now on the YouTube. So, but if you are interested in investing in North Alabama, good for you, because we are a hotbed for real estate investment right now. And as you may or may not know, we've got Revolved Realty here, which is our real estate company, but we also have Revolved Renovations. And the focus of that business is buying properties that need some love, fixing them up, getting them back on the market, and selling. So that's what we call flipping. You buy a property, you repair it, you flip it and sell it. Other investors like to look at the long term. That means they're looking at buying properties that may or may not need repair, and they are going to keep them for the long term. They're going to rent them out and enjoy the equity and the appreciation over the years. So one of the questions that I do get a lot is, Tim, should I look at becoming a flipper or should I look at becoming a long-term investor, a buy and hold? And the short answer is it's entirely up to you. It's up to your goals. It's up to your resources. It's up to your money. It's up to your time. A lot of different factors go into choosing which one is right for you. Now, myself, I'm a flipper. And a lot of it has to do with my age. I mean, I'm a very young 62. And so rather than looking at investing over a long-term period, I like to get in, make the house better, sell it, get a big bucket of cash as profit, and go on and do it again. So for me specifically, at my age, I'm not interested in long-term holdings. The other thing is I don't like tenants. I don't like them. I don't want to be a landlord. Maybe it's me. It's not that I don't like tenants. I don't like the idea of being a landlord. Now, I have had rental property in the past, and I paid a management company to take care of all that for me. So there are ways to be a landlord or a property owner without becoming actively involved. But again, for me, at this point in my life, the best thing is to become a flipper. Now, if I were younger, and I was had a lot more years left, and I was looking at long-term things, well, then I might consider becoming a landlord or owning rental property. Now, there are benefits to both. Okay, with flipping, you get the short-term hit. You typically get a good amount of cash. With rental property, the payback is a lot longer, but you can end up making even more money. So to help you guys understand the pros and cons of both, I wanted to pull up a chart here, and we're going to look at a home that we can purchase for $300,000, and I want to look at it from the standpoint of doing a quick flip or doing a long-term buy and hold. All right, and hopefully you'll find this information interesting, and you will get some good out of the video. And we work with investors here a lot who are elsewhere. That's one of the things about this market. You know, we're a very hot relocation market. We work with folks every day who find us through YouTube, who want us to help find them a property to move here and live in. But we also work with a lot of investors who know that this is a great investment area, and we will work with them to find investment properties, even get the work done on it, get it back rented out for them. So let me bring up my computer here, and we're going to look at a spreadsheet that I have put together that shows the numbers for flipping versus the number for buy and hold. And let me say this before we get started as I bring this up. It's all about the math. This is the most important thing I can tell you when it comes to investing in real estate. It's got to be about the math, about logic. It cannot be about emotion. The absolute worst thing you can do as a real estate investor is get emotional. get emotionally attached to a property, get emotional over any aspect of it, because at the end of the day, emotions do not generate cash. Cash is generated by the math, and I mean this: the numbers don't lie. All right, if you find a property that you feel you can put some money and time in and then turn around and sell it for a large profit, check your math. Make sure that you can do that, because I'll tell you this, everything costs more than you think it will. Okay, it's damn near impossible, especially now, to stay within budget unless you just really budget high. So it's all about the math, no emotion. I have had investors, get attached to a property, and you'll have to excuse me, I've got some sinus issues going here, so I've got teary eyes. But I've seen investors get attached. Oh, I love this house. I could do this, I could do this. And they end up spending way more money than they should. Either they bought it too expensive or they put more into it than they can get out of it. And then when it's done, they look at the after reno value and they realize they're not going to make any money. Sometimes they're upside down. They're going to lose money. So the best advice I can give you is remove emotion from investing. And remember, it's all about the math, all right? There's also an old cliche in this business that you make your money when you buy the property. And that simply means this: you have to get a property at a price that allows you to put money into it and have a profit margin, all right? If you don't concentrate on that, if you overpay for the property, you're going to lose money. If you put too much money in it, you're going to lose money. I've seen that too. Investors will go in and they will do a remodel that is honestly too good for the neighborhood where they are. Not every neighborhood warrants quartz countertops or granite countertops or custom cabinetry, okay? So it's really important that you do your homework and really work with a realtor, an agent like me that knows the area well and can advise you on what you should be paying for that property. All right, so we're going to look at our example property. This is a home that we can purchase for $300,000, and you can follow along here. We have to put 20% down. If you're buying an investment property and you're going to use a traditional mortgage company, you're going to put a minimum of 20% down. All right. You're also going to do rate buy down. Now, what is a rate buy down? Rate buy down means you are paying for points to buy down the mortgage interest rate. All right. By that I mean, if you look, we've got a $300,000 house. We're going to put down 20%, which is 60 grand. We're going to finance 240,000. So if I wanted to buy down that interest rate, I could pay 1 point, which is 1% of the loan amount, or $2,400, and I could get my interest rate down, say, 1/4 or 1/2 point. So the best deal that I could find here locally for investments through a mortgage company is buying down 2 points. And again, the loan value is $240,000. 2 points would be $4,800. All right. That goes into the cost of purchasing the property. So it's $300,000. We're putting down 20% or $60,000. We're going to do a rate buy down of $4,800, and then we're going to have about $6,000 in closing costs. Closing costs are things like title fees, attorney fees, lender fees. They typically can run anywhere from 2 to 4%. We're going to put them at 2%. So 2% times 300 means our closing costs are going to be roughly around $6 grand. So cash to close, we're going to have to bring $70,800 to the table. You see how I got that? $300,000 is the price, but I've got to bring $60,000 down, $4,800 to buy points, and $6,000 in closing. So I have to come to the closing table with $70,800. So that $300,000 home is going to cost me right around $310,800 to actually purchase. All right. So we are putting down 20%. So we are going to finance $240,000. Interest rate, because we did the buy down of points, 7.5. So our monthly payments, this includes taxes and insurance, roughly around $2,100. All right, so that's what it's going to cost us to get into this house. All right, so now let's look at what we're going to do as far as renovation. It's roughly going to take about 4 months from the time you close on a house to the time it's ready to go to market. 3 to 4 months is really the average. So we're going to go with 4 months. So remember, we invested a total of $310,800. We're going to put $75,000 into this house. Now your reno budget really depends on what you're going to do and how nicely you're going to do it. All right, so in our homes, we typically are in good, really nice neighborhoods. So our remodel costs could include a roof, HVAC, new windows, flooring, paint, new hot water heater. We're going to remodel the kitchen. We're going to remodel the bathroom. So we're just going to take an average number of $75,000. So we're going to put $75,000 into the repairs, and it's going to take us about 4 months. And we got to pay a house payment during that time. So $2,100 a month times 4 is $8,400. So at the end of the 4 months, my total remodel costs, my purchase and remodel, we're in for $394,200. All right. You can see why it's really important that you have access to cash. All right. We use a lot of lines of credit. We have our own cash that we use, but it's always going to cost more than you thought. So if you thought you were going to buy this house for $300,000, put 20 in it and make 100, you are sadly mistaken. So, and these numbers are really indicative of deals that we have done. So I know they're pretty accurate. All right, so let's see what we can get for this house. We've done a really nice remodel on it. We look at the market now, and we realize that comps are around $450,000, which is a good thing, right? So if you look at, we're all in for $394,200. We can sell it for $450,000. And let's say we get a contract pretty quickly. It's full price. It's still going to take us 30 to 45 days to get to the closing table. So we have to take that into account. But let's look at the rough math of what we're going to make on this flip. All right. We've done our work. We've got an ARV value of $450,000. We put $75,000 in remodel. We've made 6 payments by this time, because typically if it takes us 4 months to remodel, and then we get a contract, we're looking at least 45 days, 60 days, so we're going to call it 6 months. So 6 months worth of house payments, $12,600. Commissions. Now, you can sell a home on your own. You can certainly FSBO it. If you can do that, great. You're going to save a ton of money. But typical or average real estate commissions are about 5 to 6%. So we're going to use 5% here as the commission structure, because that is pretty much becoming the norm. So we're going to pay $22,500 in commissions. We're going to have closing costs again. Again, those could be our own title fees. The buyer may ask us to pay some closing costs. All right. So once we do that, we've got to pay out the loan of $240,000, and we're going to recoup our $60,000. That's not profit. That's what we put in it. So at the end of the day, end of the deal, $450,000 minus all of our costs is going to give us a rough profit of $30,900. Not a bad payday, not bad at all. That's kind of average. We have done flips that have been anywhere from $25,000 profit to, I think Chelsea got over $100,000 on one of hers. And again, it really depends on how cheaply you can buy the property, what you have to do to put in it. But $30,000 for a flip is not bad. Not bad at all. If you do one at a time and you do 3 of these a year, you're going to profit about $100,000. You know, we try to keep 5 or 6 going at any time, and yeah. So anyway, so that is the scenario of flipping this home. We're doing the quick flip, buy it, fix it, get out. All right. So let's look at if we were going to buy this same property to rent out. All right, so same deal, $300,000 purchase price, $60,000 is our down payment, $4,800 in rate buy down, $6,000 in closing costs. We're cash to close $70,800. All of this is the same. All right, we're going to buy the house. So let's look at our 4-month renovation cost to do a rental. Okay, we're total invested is again was $310,800. We're only going to put $50,000 into this remodel, and here's why. We are doing this remodel to rent. So the home does not have to be high end. We may not replace the roof. We may not replace the HVAC. If things are working fine to do a rental, we're not going to replace them. All right. So our reno cost is going to be considerably less than it would be to flip. All right. We may be able to just go in and do paint and flooring. We may not have to do anything. But for this example, I'm going to say we had to go in, it needed new windows. The water heater was shot. We had to do cosmetic. We're going to spend $50,000 rather than the $75,000 that we did to renovate for flip, all right? So we're also going to have 4 payments at $2,100 each. So by the time we get to the end of month 4, we have put $369,200 in this home. The good news is we have it appraised, and it appraises for $380,000. Immediately, we have about $11,000 in equity, which is a very good thing, okay? Equity and rent is an appreciation of what's going to drive the profit. So let's say we put it on the rental market. We can rent it out for $2,700 a month. Our mortgage payment is $2,100, and we're going to net $600 a month. Now, keep in mind, this number does not include account management, property management fees, vacancies, repairs, damage, any other fees that you have. All right. Typically, if you've got a rental property and it's rented 80% of the time, that's about the norm. All right. You may be lucky enough to find a tenant on day 1 who lives there forever, and if you do, you're good to go. If you don't want to pay a property manager, you are managing your own property. Keep that in mind. You know, if you've got 1 or 2 or 3, manage it yourself, because property management fees run 10 to 15%. So think about this. If we were netting $600 a month, but we were paying $270 a month in property management fees, 10%, that's going to knock this down considerably. All right, so keep that in mind. When you're starting out, cut corners as much as you can as far as expenses like this. So anyway, if we go with this scenario, our $600 a month is going to give us $7,200 a year in profit. All right, and again, this is blue sky, perfect scenario. Don't hate me in the comments and tell me that I forgot things, because I didn't. I'm trying to keep this simple. All right, so this is what we would be looking at if we were doing this as a rental property. So let's compare now and see where we do make the most money and we have the most potential, okay? So if we look at the quick flip, remember, these are all our numbers. We got a profit of $30,900. Now, the one question I always ask is, okay, if I'm going to rent this property out, how long will it take me to make the same amount of money that I did if I was going to flip? So in this scenario, $30,900 is my flipping profit. I'm going to look over here at my rental. If I'm getting $7,200 a month, in a perfect world, after 4.3 years, I'm going to net roughly about the same. All right, so if I'm doing a rental with this rate of return, it's going to take me a little over 4 years to make the same money that I would have if I had flipped it, okay? But wait, there's more. The beautiful thing about buy and hold is the property is going to bring you more return year after year. So if we look at the house after 4.3 years, the price has gone up considerably. That house that appraised at $380 4.5 years ago, or 4.3 years ago, is now worth $440,000. This means we have had an increase in equity of $60,000. We've also paid down our loan a little bit. You know, after 4.3 years, you haven't really hit the principal too much, but we're going to say that we've knocked the principal down by $5,000, so that's another $5,000 in equity. So if we look at this rental property after 4.3 years, we have recouped $30,960 in monthly rent, but we also have gotten $65,000 in appreciation and gain in our equity. All right. So after 4.3 years, we've got a $95,000 gain. All right. And again, don't beat me up on these numbers, guys. I'm trying to keep them simple. I know you experts out there, you go down to the penny and you're going to give me shit. But I'm trying to keep this simple. All right. So this is the question. Do you want to do the quick hit and you do the quick flip, you get that $30,900, you go do it again and again and again? Or are you in it for the longer haul and you're going to hang on to this and enjoy appreciation and equity and that sort of thing over the years? You know, again, it really comes down to you. One thing that I look at is I can take the profit from that quick flip. I can take that $30,900 and I can go do it again and again. And every time I do that, I'm playing with more of my own money, so my profits actually will go up. All right, and you know, the nice thing is to get to a point of where we are now with Revolve Renovation, where we have a good reserve of cash. We also have a lot of lines of credit that we can tap. So I can literally buy real estate with really zero out-of-pocket money, playing with everybody else's money. But again, it's up to you. Now, let me say this. One thing I hear a lot about the rental property is, oh, it's passive income. I'm doing this as passive income. Let me tell you something. When it comes to real estate, unless you have someone doing 100% of the work for you, managing tenants, finding tenants to put in properties, handling repairs, it's not really passive. All right, you can put a property manager in there, but you're still going to get the phone calls from the property manager. You're still going to have to deal with things. So is it really passive? I think that's subjective. I don't think it is, but what do I know? So anyway, guys, so there you go. That is a comparison between the quick flip, the buy and hold, the money that you have to put into both, the money that you can get out, and hopefully that will give you a better understanding of how we flippers and landlords do our deals. And if you are interested in that, maybe this will give you some information. The big thing, guys, is do your homework. Always do your homework. Always look at the math. You know, I advise every investor to have a really great realtor that they work with, because a great realtor can find you deals, but they can also advise you on the market, on the viability of the the ARV, what you're going to get for it, etc. So, hey guys, I hope that was helpful. If you like what we do here on the channel, do me a favor, click that little subscribe button, give us a thumbs up. If you click the bell, you'll never miss another video. And if you are looking to relocate here to North Alabama or to invest in North Alabama, give me a call. My information is below. We've got 90 some odd agents now, and some are odder than others, who are ready to go to work for you. Again, we work with folks who are relocating here to live, as well as investors who are looking to make money in this market. So, all right, guys, I hope that was helpful. If you got some value out of this, do me a favor, drop comments below, let us know. And otherwise, I will see you on the next video. All right, bye. Have a great day.